anytime market goes back into the trend line, you must wait for liquidity. You must wait for liquidity to be swept, one, and two, you must wait for a break of structure to occur. These are the two things you have to wait for: liquidity to be swept, break of structure, and then it retests the market. So let's use here as example. Market went back up here. Has liquidity been swept? Surely liquidity has been swept here. There is liquidity above this point in the market. Why? Because that is a supply zone. Remember it was said earlier on that a supply zone is the start of, is an order block that lead into the break of structure. Now, if you notice from here, price went down and it broke. This is a low in the market. This is a low in the market. So price went down and it created a lower low. So that is our supply zone. So therefore there is liquidity staying there. So after price take out this liquidity, then there must be a break in structure before you take this trade. And a break in structure is a lower low must be taken out. Yeah, for this, there are more ways you can identify breaking structure, but for the sake of this tutorial, to make it simple, a lower low must be taken out, or a high must be taken out before you consider something a break of structure. So after market went up to this moving average, market broke, and then market created a lower low here. This was a new lower low because this was the previous low that market just took out. So after market took liquidity, it went down. It could not break any. See, notice that once market went down, there was no breaking structure. It went back up, and then the breaking structure occurred after it broke. After it broke and it closed below all of these lows here. So when it closed here, that is now a breaking structure. Then market went back up, and then you can take your trade. You can trade once there's a breaking structure, then you can take your trade at the close of any FEG. And seeing that this is a short scenario, you would have taken your trade here, and you put your stop loss at the first point that touched the market, and then you can target probably 1:2 or 1:1.5, and that would have been a good trade.